Have you ever stopped to think about what our global financial markets actually are? It's not just about flashing numbers on a screen. It's really this massive, incredibly high-speed machine. And today, we're going to pop the hood and look at the interlocking gears that keep that machine running. And, more importantly, what happens when they grind to a catastrophic halt.
So, here's our game plan. We're going to start with the two faces of liquidity. This is the absolute lifeblood of the whole system. Then we'll get into the engine that's driving it all, high-frequency trading. We'll see how these pieces can lock up in what's called a liquidity spiral, check out the gauges we use to monitor the system's health, and then ask the big question, can we actually prevent the next crash?
All right, let's start with the most fundamental parts of this whole machine, the two sides of liquidity. I'm telling you, if you get this distinction, you'll understand pretty much everything about how markets work and how they break. Before we get into the definitions, just think about it for a second. When you hear somebody say a market is liquid, what does it actually mean to you? Is it just about being fast, or is there a little more going on under the surface?
Okay, this right here is the critical distinction. On one side, you have market liquidity. That's all about trading stuff. Can you sell a bunch of stock without tanking the price? On the other side, you have funding liquidity. That's about cash. Can you get your hands on actual money when you need it to pay your bills or meet a margin call? They sound kind of similar, but they are two totally different gears in our machine. And as we're about to see, the way they connect is where all the danger is hiding.
So if market and funding liquidity are the gears, what's making them spin like light speed? Well, that brings us to high-frequency trading, or HFT. Think of it as this supercharged experimental engine someone bolted onto the machine, pushing everything to speeds we've never seen before. And just to give you an idea of the sheer scale we're talking about, look at this number. High-frequency trading firms make up only about 2% of the trading firms out there, but they account for a jaw-dropping 70% of all the trading volume in U.S. stocks. This isn't some tiny corner of the market. For all intents and purposes, it is the modern market.
But here's the thing about this engine. It's a total double-edged sword. When things are calm and stable, HFT is great. The algorithms are constantly placing orders, and that tightens the gap between buy and sell prices, making it cheaper for all of us to trade. But the dark side is what people call liquidity fragility. See, these algorithms are programmed to run from risk. So the second a crisis hits, they can all decide to pull their orders from the market at the exact same time. And just like that, poof, liquidity vanishes, turning a tiny dip into a massive, terrifying crash.
And that right there brings us to the most dangerous part of our machine, the liquidity spiral. This is the moment when our two gears, market liquidity and funding liquidity, stop working smoothly together, and instead, they lock up into this vicious, self-reinforcing downward cycle. A couple of researchers, Brunermeyer and Pedersen, absolutely nailed this concept back in 2008. They were the ones who really showed that these aren't two separate things happening. No, they feed on each other. A problem with one can trigger a complete catastrophe in the other.
So how does this spiral actually get started? Well, it often kicks off with a funding shock. Think of something like a margin call, which is basically your broker demanding you put up more cash right now. To get that cash, a trading firm has to sell assets. But this sudden wave of selling just overwhelms the buyers, which dries up market liquidity and pushes prices down. Now, as prices fall, the firm's other investments lose value, which makes their financial situation even worse, triggering, you guessed it, even more margin calls. So they have to sell more, and you can see how the whole thing just spins out of control into a total collapse.
And if you think this is just some academic theory, think again. On May 6, 2010, this exact nightmare scenario played out for real in what we now call the flash crash. One single large sell order started a chain reaction of automated selling by HFT algorithms. In just a few minutes, the market basically disappeared. The Dow plummeted almost 1,000 points as liquidity just evaporated, only to bounce back almost as quickly once the algorithms backed off. It was a terrifying real-world example of a liquidity spiral in action. Okay, so we've seen how this machine can completely fall apart. So how do we stop it? Well, now let's look at the dashboard, the special gauges that have been developed to try and monitor the system's health and hopefully prevent another meltdown. First up on our dashboard is a gauge for that market liquidity gear. It's got a kind of nerdy name, VPIN, which stands for Volume Synchronized Probability of Informed Trading. But what it really does, in simple terms, is measure how toxic the trading environment is getting. So what the heck is flow toxicity? Well, it's pretty much what it sounds like. It's when the market gets
poisoned. Imagine you're a market maker. Your job is to always be buying and selling. The flow gets toxic when a bunch of informed traders, people who know something you don't, all show up on one side of the market. If you keep trading with them, you're going to lose your shirt. VPIN basically acts as a toxicity meter for the entire market.
And here's the kicker. When researchers went back and applied the VPIN metric to the 2010 flash crash data, they found that it was signaling extreme toxicity for hours before the crash actually happened. The warning light on the dashboard was flashing bright red, but back then, nobody was really watching it.
Okay, so that's market liquidity. What about the other gear, funding liquidity? Well, after the 2008 financial crisis, regulators came up with a new gauge just for this. It's called the Liquidity Coverage Ratio, or LCR, and it's aimed right at the big banks.
The logic here is actually pretty simple. The LCR forces banks to keep a big pile of what are called high-quality liquid assets. Think of it as a financial survival kit. And that pile has to be big enough to cover all the cash they could possibly need to pay out during a nasty 30-day crisis. So what exactly is in this financial survival kit? High-quality liquid assets, or HQLA, are things you can sell and turn into cash almost instantly, with little to no loss in value, even when the rest of the market is in a complete panic. Yeah, as you can see, we're talking about the absolute safest stuff you can own. Cash sitting at the central bank, top-tier government bonds, and some really highly rated corporate debt. These are the assets that have deep, resilient markets that will be there when you need them the most.
And that all brings us to our final and maybe most important section. We've got these new gauges on the dashboard, which is great, but in a system that's just getting faster and more complicated every single day, is it really enough? Can we actually keep up with this machine that we've built?
The reality is that it's this constant tug of war. On one side, you have regulators putting in tools like circuit breakers that just automatically halt all trading when things get too crazy. But on the other side, the trading firms are locked in this relentless technological arms race, spending millions and millions on new fiber optic cables and microwave towers just to shave a few microseconds off their trading time. And that leaves us with the ultimate question, doesn't it? In a world where trading speed is measured in millionths of a second, are our human-designed safety nets, like VPIN and the LCR, just doomed to always be one step behind? Can we ever truly make this machine safe? Or is the next big liquidity spiral just a matter of when, not if? That's a question that everyone, from Wall Street to Washington, is still desperately trying to answer.